Hello everybody, Tortoise Investing coming at you today with 3 monthly paying dividend stock, ETF, and a BDC. If you are new, hit that subscribe button for me, drop a like down below. Those two things help the channel and the videos out a ton, and I greatly appreciate it. And comment down below, do you own any of these? Do you own any monthly payers? Let's talk about it. Love to hear from you, and know this financial advice. Always do your own research for investing. Also, let me know what you think about the new camera setup instead of having it like completely block out all of the background. I think it looks a little rough at times, especially if I move around any. Let me know if you prefer this look, or I can go back to the way it was beforehand. Whatever yins want, I'll do. But before we dive into those monthly payers, let's take a quick look at my personal portfolio. This is how things are looking currently. Up big on my Salesforce position. Kind of bummed about that. I wanted more, but that's okay. United Healthcare is up as well. And we're down on MasterCard and Celsius. And I am looking to add more MasterCard. I get paid the next Friday coming up. And I'm hoping that MasterCard drops more. And Visa is another one. I would be perfectly fine owning both of those in my portfolio. They are both fantastic compounding machines. And I want to make this a portfolio full of winners. I feel like I've got some great winners here. Built up some pretty nice positions at pretty great price points. Now, the reason yins are here. Main Street Capital, this is our BDC that we're going to be taking a look at. One of the most popular BDCs, I think, out there. Dividend yield, 8.26%, pretty good. Take a look here over the last 5 years, up 22.55%. Over the last 10, up 53.33%, paying that dividend the whole time. Revenue's been increasing year over year very nicely, as you see here at a rate of 13.83%. That is beautiful. And cash flow has been a little bit everywhere. BDCs are a completely different beast. If this is something that you're looking to get into, definitely do research. They're taxed differently. It's the same thing as REITs. REITs are taxed differently. So make sure you're doing proper research before jumping into any investment. But it is a very solid EPS growing, revenue growing BDC. They have a great growth history. I think since 2011 they've been doing hikes every year. You see these little extra blips in here and the big ones here. Those are special dividends that they issue. It doesn't mess with their streak. They're currently on like a 15-year streak, I believe. But very consistent growth over the last 10 years, increasing that dividend rate of 4%, which is really good. Really, really good. Like to see that. Generally, you don't want to just invest in something that's growing a dividend by like 1-2% each year, because then inflation's going to start eating into your dividend income and your overall profits. Now, this is one of the more popular ones. I think it's pretty pricey right now, but if you were looking for a monthly payer and a BDC and you understand how BDCs work, this is like the BDC. I like them. I wouldn't mind to see a little bit of a pullback myself, but up 16.2% year to date. Pretty great revenue. Looks like they are forecast to grow $529 million to $540 million next year, and EPS looks like about the same. But yeah, growing revenue, gonna be a growing dividend as well. Next up, Realty Income. This is a REIT, the monthly dividend company, as they refer to themselves as. 5.98% on the dividend yield. We'll take a look here over the last 5 years. Down 19.87%, and over the last 10 years, up 22.72%. You got some very volatile drops here and there. Interest rates higher for longer has definitely hurt this company, and a lot of debt-heavy holdings as well. But the revenue, as you see here, is just taking off like a rocket. This thing's growing like crazy. Free cash flow is increasing. And with REITs, they pay their monies from funds from operation. The AFFO is what you want to check with this one. As you can see, this has a great growth history of just up and to the right. It's still early in 2024. This isn't all of 2024. I'm sure that they are going to be perfectly fine. If you multiply this by 4, you're setting at like 412, I believe. So even if they just did the same thing for their AFFO next 3 quarters, good to go, in good shape. Now, the dividend's been increased at a rate of 4% over the last 10 years. Here recently, they've been doing right at 3%, so it's kind of like that. But it is, like I said, it's the monthly paying dividend company. This is a REIT that has paid through the dot-com bubble, through the financial crisis, through COVID, things that have completely broken some companies. They have just kept trucking right along. Now, the revenue with this one, we don't really want to care too much about EPS. You want to be looking at the revenue. Revenue's been projected at $4.93 billion for 2024, growing to $5.08 billion in 2025. Now, like I said, when it comes to real estate investment trusts, they are taxed differently. So again, do your own research and stuff. See how that is taxed where you live. Next up, Devo. I like Devo a lot. This is a covered call ETF. Let's take a look here. Over the last 5 years, growing at a rate of 27.85%. Over the last 10 years, at a rate of 54.68%. Very nice growth over that year, over those years, and like I said, you're getting a pretty solid dividend with them as well. Let's take a look at the dividend. This has been pretty flat for a while. This has been hovering between 14, 15, 16 cents monthly. Again, all of these are monthly payers. Since about 2019, it's been hovering around that same area, but with this one, you're getting pretty good price appreciation. Like I said, over the last 5 years, 27.85. Over the last 10, 54.68%. Now, what makes Devo tick? So we'll take a look at that. Devo does have an expense ratio of 0.56%, so a little bit on the high side, but a lot of your cover call ETFs are going to have that. But what makes it tick? Devo's holdings here. Let's see, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Take a look at the top 10. Boop. United Healthcare Group coming in at 5.54%. Microsoft coming in at 5.35%. Caterpillar coming in at 5.04%. Home Depot 5.03%. Procter & Gamble 4.97%. JP Morgan 4.89%. Goldman Sachs 4.75%, Visa 4.74%, Apple 4.11%, and Honeywell International at 4.10%. So a very solid, strong top 10 when it comes to their overall holdings, and you can have all the access to this off their Amplify ETF's website if you would like to dive in further. Now, another fun little thing that I did is I made a little spreadsheet here. If you were to invest $1,000 into each of these, what are you getting? If you put $1,000 into Main Street Capital, you're getting 19.81 shares, and it's going to net you about $4.85 a month. And you can use that to roll into itself to buy more shares and get that snowball a-rolling. Again, this is only $1,000. And a lot of people have a lot more than that in some of these. Realty Income. Going to net you 18.93 shares, $4.98 a month. The Amplify CWP Enhanced Income ETF, 25.84 shares, $4.13 a month. Now, those are the three. One ETF, one stock, one BDC. I hope you enjoyed that. Make sure to hit that like button and subscribe for more. Again, let me know down below if you own any of these or if you own any monthly payers. And until next time, I hope everyone takes care. See yous.